How your PHA spends EPC savings from frozen rolling base and resident-paid utility incentives impacts the amount of savings your PHA can retain. EPC projects generate savings through a decrease in energy consumption. Your PHA is eligible to keep 100% of these EPC savings from frozen rolling base and resident-paid utility incentives by meeting the 75% rule. Under the 75% rule, a PHA must use at least 75% of EPC savings from frozen rolling base and resident-paid utility incentives to pay off eligible project costs. For example, paying off the contractor or bank loan. Any remaining EPC savings over the 75% become operating funds that may be used by the PHA for eligible operating fund expenses. Important note: the 75% rule does not apply to the add-on subsidy incentive. So as a simple example, let's say your PHA has a total of $100 in EPC savings from frozen rolling base and resident-paid utility incentives. Your PHA spent $75 or 75% of those savings on eligible project costs. Under the 75% rule, the remaining $25 in savings becomes operating funds. Your PHA may use these funds for eligible operating fund expenses. But be aware, these operating costs are subject to operating cost rules. So EPC savings, including excess savings, cannot be used to purchase capital measures, for example, other energy improvements outside of approved replacement costs. Also, excess savings cannot be placed in a reserve account for future EPC project costs. What if my PHA spends less than 75%? The 75% rule complies with the lesser of costs or savings rule, which compares project costs and project savings and requires that HUD only subsidizes whichever amount is lower. So, if your PHA uses less than 75% of the cost savings for eligible project costs, HUD will only subsidize the actual percentage of EPC savings used for eligible project costs. The difference between the actual percentage of cost savings used to pay off project costs and 75% of the cost savings will not be subsidized. So, again, let's say your PHA annual EPC savings from your FRB and RPU incentives is $100. To comply with the 75% rule, your PHA must spend $75, or 75%, on eligible project costs. But what if your PHA only spends $25 on eligible project costs? Under the 75% rule, HUD will only subsidize the actual project costs, in this case, $25. The difference between the $25 of actual savings used for eligible project costs and the $75 required by the 75% rule will not be subsidized. In this example, HUD would not subsidize $50. When is the 75% rule calculated? The 75% rule is calculated annually as part of the EPC incentive savings verification process, which is in line with your PHA's annual operating subsidy submission process. If your EPC project includes both frozen rolling base and resident-paid utility incentives, project costs and savings are combined prior to applying the 75% rule. The reporting period for EPC incentives, including frozen rolling base and resident-paid utility incentives, is July 1st to June 30th. After the reporting period, your PHA will submit your EPC incentive cost verification to HUD. Be aware that there is a deadline to submit your verification, which is announced every year in HUD's annual operating subsidy processing notice. HUD will then review the submission for any needed adjustments or revisions for the next funding period, which runs from January 1st to December 31st. Thank you for your commitment to energy and water conservation. For more information on the 75% rule and energy performance contracting, please see the other videos in this training series and the HUD Public Housing Energy Branch website. Questions or comments can be directed to PIH Energy Branch at hud.gov.